Welcome back, you legends. I'm Dr. Cal. Let's get right into this quick market update video. This is going to be my last video until next weekend because between now and then I'll be away with the wife. So smash that like button right in the face on your way in. My flight actually leaves in 5 hours, so I had to get this last minute video out for you guys to discuss really some huge big picture stuff. So let's jump straight into it. In this video, I'm going to skip all of the sector stuff. We're going to jump straight into the big picture stuff. So this is TLT relative to the S&P 500. That is long-term treasuries relative to the S&P. That's the charts up above. Below that is the S&P 500. This is the monthly chart, and I dub this chart the imminent doom indicator. The imminent doom indicator is triggered whenever the TLT relative to SPY chart, that is when long-term bonds begin to outperform the S&P 500 by a magnitude enough to cross the 10-month moving average. That triggers the first sell signal of the three horsemen of the apocalypse. The first horseman of the apocalypse is the inverted yield curve. As soon as the inverted yield curve exits inversion and begins to normalize, that's the first major sell signal. That sell signal has been triggered. The second major sell signal is the imminent doom indicator, and once that is triggered, we have two of the three horsemen of the apocalypse. The final horseman of the apocalypse is when the S&P 500 staples ETF or sector begins to outperform the S&P 500 as a whole by a magnitude big enough to cross the 50-week moving average. This is true also for the XLU, that is utilities relative to the S&P 500. These are the three major, I would say, signals to watch for over the next several weeks to really gauge whether this is truly a major kind of top and crash event on the horizon led by the recession, the impending recession, or whether we have some more juice left. Now, XLU relative to the S&P 500, this chart has already triggered a sell signal. So we have this sell signal in check. XLP, that is staples relative to the S&P 500, that has also crossed over. And if I take a look at the monthly chart, this is also true. We crossed above the 10-month moving average. This has been a strong predictor of negative market momentum for several upcoming months. So we have this negative trigger already in place, both the consumer staples and utilities both triggering a sell signal. The inverted yield curve has begun to normalize. That's the second key sell signal. The final sell signal that I watch is the imminent doom indicator. And I talked about this about a week and a half ago, something like that. I talked about this indicator potentially crossing above the 10-month moving average and triggering a sell signal this month. This signal requires a monthly close above the 10-month moving average, which means we cannot confirm this sell signal until the end of the month. As of right now, we are below the 10-month moving average. We had an attempt to close above it last month in August. We tried again this month. We have one more week left. And this week is going to be absolutely a game-changing, pivotal, instrumental, trend-setting, all of the above. To illustrate really how important next week is, I want you to pay very close attention to the weekly chart for the S&P 500. That is this blue and black chart, okay? Let's put the XLP consumer staples to the side for just a minute. I want you to focus on this structure, okay? Pay very close attention to this kind of structure. I want you to now look at this structure. Do you see similarities? Big significant correction, rally to all-time highs, right? Significant correction, then rally to all-time highs, consolidation, and failure to clear all-time highs for, let's see, 1, 2, 3, 4, 5, 6, 7, 8 weeks, okay? So let's see that again here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks, right? So just a 2-week differential. And then on that final week, we got the new high. On that final week, we got the new high. Let me zoom in just a little bit more. Do you see the structure? Correction, rally to new highs, consolidation. Then finally, we make a new high and a breakout. Kind of a shy breakout, right? Small candle, but it breaks the new highs And then the next week, we immediately reject and form a bearish engulfing candle. Where are we in this cycle? Next week is going to be this week. Okay, next week is going to be this kind of trend setting week. It does not necessarily mean that next week is going to be a breakdown and a sell-off. No, that's not what I'm saying. What I'm saying is that next week we will know for sure whether we are going to get a breakdown and the beginning of a multi-month, year-plus long bear market, or whether we have a lot more juice in the tank. And how much juice, I'll talk about that in a second. Okay, so this was a late 2021, just before the top and the beginning of the 2022 bear market. And look at this, it looks almost exactly the same. Does it not look almost exactly the same? Even the daily chart, even if I take a look at the daily chart, it looks eerily similar. Look at this, multiple attempts and new highs. We finally make a new high, right? Multiple attempts and new highs all fail. Then we finally make a new high. In this instance, we make a new high, then we move sideways for several days, and then we get the breakdown. And that confirms the beginning of a new bear market, especially the break of these prior lows. This breakdown confirms that we have some serious pain ahead. Right now, we are here. Next week is going to determine whether we see significant upside ahead, because we cannot ignore the fact this is a double bottom with a higher low on the daily and weekly charts. But the structure, the overall structure, is very suspicious. I'm not passing judgment. I need to see that imminent doom indicator trigger a sell signal before I go long term bearish. I'm still long term bullish, medium term, near term, all time frames I'm still bullish. But to go into that mindset of trading a significant multi-month kind of bear market, I need to see that TLT SPY. This chart, I need to see this chart close above the 10-month moving average. We will not know the answer to this question until the end of next week. So I am reserving judgment. I'll be away on vacation, so I cannot cover this in real time for you on YouTube. I'll be doing that in the Discord community whenever I can. But I wanted to put this video out so that you are aware of what I'm watching, what I'm waiting, what I'm anticipating. Okay, so with the three horsemen of the apocalypse in mind, we first have bearish defensive sectors, that is XLP, consumer staples, and XLU, S&P 500 utilities, both beginning to outperform the S&P 500. This is clearly true. This is clearly the case. We can see that on the weekly chart and the monthly charts, and that clearly signifies that we have a major bear market ahead. The question is, do we get some more juice in the tank? Does the market continue to rally until the end of the year? That is still my expectation. Or do we get the real fateful breakdown next week? I don't personally think so. I don't think the market is quite there yet. I think earnings need to show some serious deterioration first, and I think it's too early for that kind of move. But I have to stay objective, and I have to keep my objective criteria in mind and share those objective criteria with you. Now, with that being said, down below is the Money Time Machine Smart Money Indicator, and I want you to pay very close attention to what is happening here. We had a very clear cross, right? We had a cross above the zero line. It went red to green, and that signified big money rotation out of the S&P 500 and into defensive sectors. We're not seeing that right now. Pay very close attention. Look at this. No red to green. It is still red. And momentum line, it is actually now flattening. It is about to cross down. To me, this indicates that, yes, we have more juice in the tank. This is not likely a repeat of 2021. We still have more upside to go. This is based on the latest available data. To me, as of right now, I'm maintaining my outlook of a rally until the end of the year, and then a top early next year, potentially in January, maybe a little bit later. But as of right now, I think the market is putting forth a huge important question. Do we get that breakdown next week? If we do, I think the market turns long-term bearish. If we don't, if we continue to see a higher weekly close next week for the S&P, for the NASDAQ, for XLK, that is S&P 500 tech, the tech sector, that'll be bullish. And we cannot ignore the fact that we have, look at this double bottom, higher low, the second low, consolidation pattern closed above resistance last week 2 consecutive daily closures. This tells me that this is likely the real deal. What are we talking about in terms of upside? The full measured move, we have to measure it from the bottom to the touch of the resistance line. And then we take that, we put it at the resistance line at the point of breakout. And that indicates, look at this, significant 20% upside for the tech sector. Still 20% upside, still more juice in the tank. If this breakout holds this week, if it does, likely what will happen is we get a rally that looks kind of like this until the end of the week. Then a pullback in October. We form a higher low, back test of this prior level of resistance that is now support. Let me draw this again. Breakout, this is resistance, back test at resistance, and that'll give us the October bottom and a couple of weeks of vicious post-election rally. Let's take a look at election seasonality. We tend to get a bottom at the end of October, a late September top, then we get a sell-off, a bottom at the end of October, and then a couple of months of very strong rally. This is still my expectation based on what I'm seeing from both fundamental and technical data until and unless the imminent doom indicator confirms a sell side signal at the end of this week. We will likely continue to see more upside. Now let's jump to the daily chart for the S&P 500. RSI is at 60, so positive but not overbought. We have this double bottom with a higher low structure, a very bullish reversal candle on Wednesday. We covered this. We had a target in Money Time Machine of 575 for the S&P 500 by the end of September, 571 by the end of last week. We actually hit 571. This is the upper expected move. We already hit the upper expected move. We had 2 indecision candles, but both closed above the 5-day moving average. Still looking bullish. Still looking bullish. Some hesitation, yes, but still looking bullish. Look at the volume. Green volume eclipsing the red volume. Still above the 5-day moving average. S&P still looks bullish. We're not seeing that topping sign just yet. I was looking for a top at the end of this past week. As of this moment, I'm not seeing confirmation of that top. And I think the market likely continues to rally and then puts in a higher low in October and then gets that November, December post-election rally. That is still what I'm expecting. I don't think I've seen enough evidence quite yet to call the end of the cycle, this bullish cycle. What will give me confidence to call the end, the final top of that bullish cycle, is that imminent doom indicator giving us the sell side signal next week. If that happens, and if the S&P 500 on the weekly chart closes below this week, this means the weekly candle next week, if we get a bearish red weekly candle with a close below 568, that will tell me that likely this is the top. Otherwise, this is just bullish consolidation in a long-term bullish pattern in a late bull cycle, not a bull cycle that has ended just yet. We haven't seen enough evidence to indicate that is the case. If I take a look at the NASDAQ 100, again, look at this bullish breakout above this resistance. We met our 485 target for the NASDAQ 100. That was my target last week. We met that target. And look at this red sell side activity, less than the buy side green volume the day prior. Still above the 5-day moving average, still looking bullish overall. Double tag of the 200-day moving average here, double tag with a double bottom. We are now at the neckline of this double bottom. For bears, this absolutely needs to hold if we break above it. The next target, 495. If the rally stops at 495, that could very well be the top for the NASDAQ. That was initially my target for the end of the year, but we're very close to hitting that target. We could see it tagged as early as next week. Remember, next week, Micron reports, one of the earliest semiconductors names to report. And if I actually chart Micron for you, you can clearly see there's a double bottom, bullish double bottom. Look at this double bottom, kind of stagnating here because investors are waiting for that earnings report that is coming up Wednesday. If that earnings report is positive, you'll see a huge breakout in semiconductors leading the market again. Semiconductors have been lagging throughout the last several months, and if they begin to lead again, if we get something that looks like a double bottom here, right, double bottom rally, at least back to the neckline for Micron. That is, let's see, 108.5. So rally all the way to the neckline. That is the objective intermediate target. Previous level of support, now resistance, expected to be resistance again. So in the near term, medium term, expect Micron to rally, in my opinion, to 108. And after that, we will have established a double bottom with a clear neckline. And if we get a breakout above the neckline, back test of the neckline in October, that is bullish. It means the rally has more legs. I hope that makes sense, legends. Again, if you appreciate this kind of content, please slap that like button right in the face. By the way, if you're interested in supporting me and supporting the YouTube channel, the best way to do that is to join the trading community on Patreon, Money Time Machine on Patreon. But I would say to hold out, wait until the end of next week, because I'll be away on vacation. So I don't want you to sign up until I'm back. So I'll be able to help you as much as I can. Obviously, I will not be as active during my time off. So if you want to support me, I thank you very much. And the best way to do that is through Patreon. But please just wait until the end of next week. Okay, so let's take a look at the Dow Jones. Again, Dow Jones leading the market. Double bottom, new high, leading the S&P 500 and the NASDAQ. The NASDAQ hasn't even made a new high quite yet. The Dow Jones defensives still leading, not overwhelmingly bullish, I would say. You want to see the NASDAQ leading the Dow right now. We're getting more of that kind of late cycle rotation out of big cap tech, the S&P, and into defensives and into small caps, the Russell 2000. So let's take a look at the S&P 500 1 hour chart. I don't want to spend too much time on this. I already explained what I'm looking for, but generally, just very quickly here, we had a breakout, kind of abandoned this breakout. We need to recover that breakout very quickly next week to signal that buyers are still interested in this market. The stochastic has already crossed down from overbought conditions. So we are due for some consolidation as long as we hold above this prior level of resistance, now support, that is 563.8. As long as we hold above it, that is still consolidation in bullish context. If I take a look at the NASDAQ 100, rally to my target of 485 on the dot, exceeded it just slightly. Looks bullish still, pulled back slightly, but still looks like it's in bullish context. For the NASDAQ 100, I would say watch this level, this key level here, 477. If the market manages to maintain 477, that is going to still be bullish consolidation in bullish context. So just keep that in mind. S&P 500 futures, look at this. Just a pullback, still above the near-term green stair-step moving average. Still overall bullish. The blue moving average is now above the purple. That is bullish. That is a sign of an uptrend. They are expanding. The distance between them is expanding. Momentum is getting a little bit overbought. No bearish divergence. We usually get multiple bearish divergences first before the market tops. That is multiple lower highs on the RSI as the market makes multiple higher highs. This has been true pretty much in every top. Look at this. Bearish divergence, lower high here, higher high here, calls the top. That has been a staple. So no bearish divergence just yet. Still bullish consolidation in overall bullish context. Next week is going to be absolutely critical. If I take a look at the VIX has pulled back. Yesterday, it actually closed down. Even though the market was down, the VIX closed 1.1% down. This tells me still bulls are in control. This breakout failed. We could get another breakout in the VIX if we tag this support line. This means the VIX hits 15.3. A lot of you will wonder, why do you actually take a look at the VIX? The VIX is volatility index. It's the fear index. And a lot of times you'll see the VIX make the move before the market does it. That's why I watch the VIX. And here's the case in point. This is the S&P 500 making multiple highs. And this is the VIX making higher lows. This was the first warning sign that something bad was going to happen. Hedging activity was rising even though the market was making higher highs. That was the clear signal to get out of the market. So is that happening today? No, I'm not seeing a bearish divergence. The VIX hasn't even gone down low enough to actually look for a bottom in the VIX. So we're still at least several days away from a top. If next week proves to be the top, we don't know that for a fact. The overall trend indicators, breakouts all over the place. I just showed you the XLK clearly breaking out. The only way this fails is if we get an immediate failure of the breakout early next week. Otherwise, this is still consolidation in bullish context, and we continue to move higher. Let me look at some other sectors just to hammer this point home. This is XLY relative to relative to the S&P 500. This is XLY, that is consumer discretionary. Look at this. Inverse head and shoulders, very clear as day. Right shoulder, left shoulder, the head, inverse head and shoulders, very clear breakout. What is the objective target for this kind of breakout? Boom, the objective target for XLY is a rally back to 205. That means an additional 5% for XLY. What does that mean if I take a look at Amazon? This means Amazon continues to rally, still looks bullish, still has more upside to go. If I take a look at Tesla, one of my favorite setups still as of right now, look at this, very clear breakout consolidation, very clear uptrend here. We tagged or came very close to tagging the upper edge of that channel. Not quite there yet, still bullish on Tesla. In fact, I think Tesla will continue to rally all the way to this gap fill target of 246, probably even higher. We came very close to filling the gap, not quite there. I think Tesla actually rallies to 250 probably next week or even higher. So overall, still very bullish. Some major trend setting kind of big picture stuff turning bearish, but not quite there yet. Look at this XLP relative to the SPY, cross above the 50-week moving average, triggering that sell signal, but it did not follow through. We had 2 negative weeks for that rotation. This means folks are now dumping defensive positions and they're buying offensive bullish sectors like consumer discretionary, like Tesla and Amazon. If I actually show you here a very direct example, take a look at Pepsi, for example. Take a look at Pepsi. Major breakdown, spike, cup, kind of top, back at support, but very vicious breakdown. And as that breakdown is taking place, what is happening with Tesla? Tesla is rallying. What is happening with Amazon? Amazon is rallying. As of right now, we are at major levels of resistance across the board for the market. We did get a breakout from Amazon. We did get a breakout from XLK. And that is the S&P 500 tech sector. And the NASDAQ is at resistance, about to confirm or reject this breakout. If I take a look at the NASDAQ composite, very clear breakout. Look at this, flirting with that resistance line, then giving us that breakout. We're now at resistance. We need to see follow through or rejection. So absolutely pivotal next week. Again, if I take a look at the VIX, try to break above the 50-day moving average, fail to break above it, and it's still declining, still looking bullish overall. Put to call ratio, double top, still moving down, still leaning more bullish. We did have this kind of small turn here. We had a bunch of these before. These are not confirmation of bearish sentiment. These just could mean consolidation or pullback, and then we continue higher. So what do we have next week? Monday, we have a bunch of Fed speakers. The Fed obviously cut by 0.5 percentage point. That is positive for the market. That is more than what the market expected overall. Very bullish. So Monday, Fed Bostic speaking, a bunch of Fed speakers, also Kashkari speaking, Goolsby speaking. This is actually the first time I've heard of Goolsby. I've known of Kashkari and Bostic. Goolsby, that's kind of a weird name. Okay. Tuesday, we have S&P and Case-Shiller Home Price Index. Okay. And then Wednesday, we have new home sales. Thursday, GDP growth, durable goods orders, as well as Fed Chair Powell speaking Thursday, September the 26th, and Friday, PCE. Obviously, CPI came in better than expected, so expect PCE to come in better than expected. Overall, major week ahead. I'm still leaning bullish until we get that bearish confirmation from the final horseman of the apocalypse. We already have 2 out of 3 sell signals. We need to see the third. It does not have to happen this month. It could happen next month. It could happen multiple months later. So there's no guarantee it actually triggers this month. And I talked about this in the last video. You need to see all of these sell signals getting triggered. Right now, we only have 2 out of 3. We need all 3. And I haven't seen anybody on YouTube actually talk about this. I'm the only one that tracks these distinct 3 horsemen of the apocalypse based on a lot of back testing that I actually did. A lot of look back kind of analysis. And I found that when all 3 of these are triggered, we tend to get a major top. First, you want to see the yield curve reverse and begin to uninvert and normalize. That has already begun to happen, and that will accelerate as the Fed continues to cut rates. With that in mind, look at this. We can continue to rally for several months before the top is in, as was the case between September of 2019. Look at this. Fed cuts rates, and we get that reversion of the yield curve. It begins to steepen again, and the market still rallies all the way until March of 2020 when we got the early 2020 crash. Again, XLP relative to SPY, we could easily get a double bottom and then get the breakout. That means we could get additional 2 months, 3 months of rally before the market actually tops. And again, the TLT M&A doom indicator, long-term treasuries relative to the S&P, we need to see the signal getting triggered. And even after it is triggered, yes, we get a sell-off, we get a top. The market does not get that major sell-off until several months later. So even if you are late and if you miss the boat and if you don't sell or exit, you would still have several more months to get the heck out of the market before really the bottom falls off. If you watched till the end, I thank you very much. Please smack that like button on your way out. If you watched till the end and you did not enjoy the video, I still thank you for your time and attention. That's all I have for you today, legends. I hope you liked it, and I'll catch you in the next one. Bye-bye.
Oh, wow.